Have you ever wondered if the money in your pocket is really what it seems? Most of us grow up believing money is simple. You work, you earn, you spend, and the bank keeps it safe for you. But what if I told you that this idea of money, the one we all live by, is mostly an illusion? Because the truth is, banks don't just keep your money, they create it. And not in some metaphorical way. Literally. Modern money isn't printed by governments, it's generated by banks, with a few keystrokes and a lot of trust. This is the lie behind modern money. So, what is money, really? Let's start with the basics. When you look at a $20 bill, it feels tangible, solid, real. But that piece of paper is just a symbol, a promise. The real power of money isn't in the paper itself, it's in what people believe about it. Money, at its core, is trust. Trust that the note you're holding will buy you food, pay your rent, or settle a debt. Trust that others will accept it tomorrow, next month, and next year. Now here's the strange part. In today's world, only a tiny fraction of money exists as physical cash. Around 3% to 5% is printed by governments. The other 95% exists only as numbers on screens, created, moved, and destroyed inside the digital ledgers of commercial banks. The illusion of deposits. If you deposit $1,000 into your bank account, what do you think happens? You probably imagine the bank stores your money in a secure vault, right? Maybe even uses it to lend out to someone else. That's the story we've all been told, but it's not what actually happens. When you deposit money, the bank doesn't store your dollars. Instead, it records that the bank owes you $1,000. Your balance is just an entry on their books, a liability for the bank, a claim for you. Your money isn't physically sitting there. It's already been used. It's been lent out, invested, multiplied, while you still see the full amount in your account. It's a beautiful illusion, and it works only because you and millions of others don't all demand your cash at the same time. The modern money creation trick. So how do banks actually create money? Let's say you walk into a bank and apply for a $100,000 loan. You sign the paperwork, the bank approves it, and suddenly you see $100,000 appear in your account. Now pause for a second. Where did that money come from? Was it transferred from someone else's deposit? Did the bank take cash from a vault? That money didn't exist 10 seconds ago. The bank simply created it by typing it into your account as a new deposit. That's right. Your debt became the bank's asset, and your deposit became new money in the economy. The moment that loan was approved, money was born. Debt and money are two sides of the same coin. Every new dollar created through lending comes with an equal amount of debt attached to it. If you take a $100,000 mortgage, there is now $100,000 of new money and $100,000 of new debt. If everyone in the world suddenly repaid all their loans, most of the money supply would vanish. That's the uncomfortable truth. Our money system requires debt to exist. Without borrowing, the economy would literally run out of money. It's a strange, almost paradoxical loop. Money depends on debt, and debt depends on trust. The cycle of creation and destruction. Now you might ask, if banks can create money whenever they lend, can't they just create infinite amounts and make everyone rich? Not exactly. Banks can only lend when borrowers are willing and able to take on debt, and when the central bank allows the system to expand. When people borrow, new money flows in. When they repay, money disappears. That's why the economy feels so fragile. When credit expands, we get booms. Stock markets rise, housing prices surge, people feel wealthier. But when credit contracts, everything deflates. Money doesn't flow like water. It pulses like a heartbeat. Expansion, contraction, creation, destruction. The real source of inflation and inequality. Here's where it gets interesting, and a bit uncomfortable. Because banks decide who gets loans, they decide where new money enters the economy. When they lend mostly to homeowners, investors, and corporations, that new money flows into assets, houses, stocks, bonds. Prices rise there first. But everyday workers, who rely mostly on wages, don't see the same benefit. Their incomes rise slower, but the cost of living keeps going up. This is why asset prices can boom while regular people feel squeezed. The money that banks create doesn't go evenly into the economy. It goes where banks see profit and safety. In other words, modern money creation naturally concentrates wealth. The role of central banks, the bank of banks. Now you might be wondering, wait, what about the central bank? Don't they control how much money exists? Yes and no. Central banks don't directly create the money you and I use. They create base money, the foundation of the system. Commercial banks build on top of that foundation by creating loans. Think of it like this. The central bank builds the playing field and sets the rules: interest rates, reserve requirements, liquidity limits. Commercial banks play the game. When the central bank lowers rates, borrowing becomes cheaper. Loans increase, more money is created, and the economy speeds up. When it raises rates, borrowing slows, loans decrease, and the economy cools down. So while the central bank doesn't print all the money, it absolutely controls the rhythm of creation. The hidden cost of the system. The system we have today seems efficient. Money can be created instantly, credit flows easily, growth happens fast. But there's a hidden cost: instability. Because money creation depends on lending, every major expansion is followed by a painful correction. The 2008 financial crisis is a perfect example. For years, banks created enormous amounts of money through mortgages. Everyone believed housing prices could never fall. But when borrowers started defaulting, that newly created money evaporated. Banks stopped lending, credit froze, and the entire global economy nearly collapsed. In a system where money equals debt, when confidence breaks, the whole machine stalls. The moral paradox of modern money. Now here's the moral twist, the part that makes people really uncomfortable. When you work hard for your paycheck, you're exchanging your time and energy for money. But when a bank creates money, it doesn't produce anything tangible. It simply types it into existence and charges interest for it. In essence, banks profit from creating what everyone else has to earn. It's no wonder some people call it legalized alchemy. This isn't to say banks are evil. They're doing what the system allows, and honestly, what the system depends on. But it does raise an uncomfortable question. How fair is a financial system where the ability to create money is concentrated in the hands of a few private institutions? Why we keep believing the old story? If the truth is that banks create money, why don't people know it? Why do we still imagine our deposits sitting safely in a vault somewhere? Because that illusion keeps the system stable. If everyone suddenly understood that banks only hold a fraction of their deposits, confidence might collapse overnight. Remember, this entire system runs on trust. So the story we're told, that banks are simply intermediaries between savers and borrowers, is comforting. It's simple. It feels safe. But it's not the full story. It's the children's version of how money works. The real danger: trust itself. Our entire economy depends on the belief that digital numbers represent real value. If people lose that faith, if they stop trusting banks or governments or currencies, everything stops. That's why crises are always about confidence. 2008 was about confidence in mortgages. The COVID crash was about confidence in global trade. Bank runs, stock crashes, currency collapses, they all start the same way. People stop believing. The scary part? Money doesn't need to exist physically to disappear. All it takes is lost confidence, and those digital dollars vanish in an instant. Is there a better way? Some argue that governments should take back control of money creation, that private banks shouldn't have the power to create money for profit. Others say the system, while imperfect, has fueled unprecedented growth and innovation. It just needs stronger rules and oversight. And now, a new player is entering the scene: digital currencies. Central bank digital currencies, or CBDCs, could give governments direct control over money creation again. But that also raises new fears about privacy, control, and freedom. The next evolution of money might fix some old problems and create entirely new ones. So, what's the lie behind modern money? It's not that the system doesn't work. It does. The lie is that we've been told money is something solid, something backed by hard assets or the government's full faith. In reality, money today is just credit, a promise created and sustained by trust. Our financial system isn't built on gold or paper. It's built on belief. And as long as that belief holds, the system survives. Wrapping it up, so the next time you open your banking app and see your balance, remember, that number isn't sitting in a vault somewhere. It's part of a delicate network of promises, a web of debts, credits, and trust that holds the modern world together. It's an elegant illusion, one that's both brilliant and fragile. If you want to understand how money really works, not the version in textbooks, but the version that runs the world, make sure to subscribe, and I'll see you in the next episode of Money Explained.